I'm just thinking of some deals that we've done. I mean, equity is not necessarily raising money in the equity markets. Some companies will tell you, and it's in one of our case studies. I don't want to ruin the surprise, but in one of our case studies, the company's got a stockpile, and then they say, "Well, look, we've taken over the operations from a previous client or previous mining company that we've bought the operation from. Here's a stockpile. This is our equity contribution. We're not going to raise any additional equity in the equity markets. So this is our contribution. And you can look at, we only want to raise this debt facility in a year's time. Between now and a year's time, look how much money that we're going to put into developing the mine ourselves. So it's just skin in the game. Essentially is what the reference to debt and equity is the abandonment risk. So if they're putting in zero and times get tough and it's just the bank's problem, then there's a high probability of abandonment risk. More or less understanding what you're trying to achieve, and that will drive what you do. So if you have a project where they've been doing the initial phases of construction for the past year and a half, and they just need bank funding to just get them over the line, um, your 50-50, I mean, you can quantify what the client has done, but you're not going to ask them to raise money on the equity markets just to put the debt in. You would view that there's a low abandonment risk. And I think that's what you're trying to achieve as debt funders. On the other side of things, the equity providers would be looking at the leverage um, because they share in upside. Remember that as debt funders, you don't get any upside. So whether this thing shoots the lights out, you're still going to get your contractual interest. And whether it does just scrapes through, you're still going to get your contractual interest. So you don't see any upside. So whether the debt to equity is 50-50, 60-40, 70-30, the point that you're trying to achieve is just minimizing abandonment risk. And whether you can convince your credit committee that they've got sufficient skin in the game, even if they have a 5% slug in there, and the rest is pretty much funded by debt and mezzanine. If you can convince yourselves and your credit committee that there's very low abandonment risk, then you've done your job. But on the equity side of things, they'll be running the numbers and saying, if we gear this thing up to 70%, this is what our cost of capital will be for the business. Your cost of capital is just your weighted average of your debt and your equity cost. So you want your cost of capital to be as low as possible. So if you can get cheap debt, get as much as you can because that lowers your cost of capital. And your cost of capital is just a measure of financial efficiency, right? So you're getting $1 in and $2 is coming out. How expensive is that dollar that's coming in? Is that dollar that's coming in, does it cost you 10% to service that dollar? Okay. That's like equity returns nowadays, maybe 15%, I don't know. So you're getting $1 to come in, but it costs you 15% to get that dollar. But if you get that dollar from the banks, it costs you 5%. So you just lowered your cost of capital, of attracting capital. So you'd want to get as many cheap dollars as you can, because if the cost of getting that $1 is only 5%, and you know when that dollar is in the business, it generates $2. Now, if I can raise dollars at 5% versus 15%, then it increases the upside to the shareholders. So just bearing in mind that as debt holders, you're pretty much agnostic as to what the upside is. It just you just want to make sure that the thing can repay you at the end of the day, and you just want to fight or mitigate abandonment risk. Yeah, I guess at the end of the day, the main test is when things go bad. Do you think that the shareholders, because they've got enough skin in the game, would put more money? And a credit committee is trying to achieve the same thing. They don't want any abandonment. So if there's a cost shortfall, unfortunately, the banks have put a billion in. The banks want to see their billion come back, but shareholders are like, "I we only put in 100 million. Let the banks deal with it." that's exactly what you want to guard against. So I guess that's the what that's the subjectivity. I guess the gut feel comes from credit committee putting themselves in the shoes of shareholders that, nah, if things go bad, let's just do a game of chicken where we'll wait for the first person to blink. And I think the banks are going to blink because they've put in much more than we have. They have much more to lose. But if it's a 50-50, then equity holders are thinking, yo, the banks are senior secured. If we don't stump up some equity, we're going to lose everything. And the banks can just take the plant and the mining right, and they can take whatever they want, and they'll be made whole. So we, as shareholders, we have to stump up the equity to get this thing going, and that's fair because the banks are not seeing any upside. It's fair. So I think that's what you're trying to achieve in that scenario. Okay.